Hello and good evening. You are watching the Policy Times, a very exclusive program on especially US. Now, Policy Times as a development media, the core focus of Policy Times is, and we are a little serious media. So we aim to be world's first policy and development media. Every program and every episode or webinar that we do, we have a very simple and clear objective that it has to bring some positive change or positive contribution in nation building or social development. We work in education, healthcare, technology, entrepreneurship, sustainability, agriculture, couple of these sectors, and in a very focused way, a dedicated way. Whether it is uh, you know, doing advocacy through media, to doing policy advocacy through our research work, or through events and conference, bringing different experts and stakeholders in a single platform to discuss, deliberate, and brainstorm on very important issues that again directly indirectly impact our society. Now, Policy Times is again aiming three important countries, and all the participants who are here, I want to say there are three countries. If you, whether you are into education, whether you are into whichever business or professional or a job seeker, there are three countries we need to target if we really want to capture the global market. So these three are United States, China, and India. People say, not me. I don't want to take the controversy. That these three countries are past, present, and future. Okay, which one is past, which one is present, and which one is future? Please don't ask me. But these three countries' role will remain absolutely important, singularly important in the global, whether it is geopolitics, economy, or society. So here, this special program under Policy Times and Indus International Research Foundation, and also the Institute of Chartered Accountant of India, we all together are trying to organize a series of programs on US market outlook, at the same time understanding the United States market, so that India and United States can build a very robust socio-economic relation for mutual benefit and development. With this, and the moderator, chairman of this show is Guru Savle, who is the financial advisor of Edward Jones, again, one of the leading financial advisory firm based in the United States. I can't stop mentioning it. The other organization which we have, and the representative, we have the director of market leader, North Texas, BlackRock. I think many of you know it is the Microsoft of computer, or Microsoft of the financial market, or Amazon of the financial market. And the kind of portfolio, the kind of reach it has, it is definitely, it makes a huge impact in whichever field or whichever organization it pays attention to. So without any more time, we will have a small interaction between Guru and our speaker from United States, BlackRock. And after that, we will do a quick question answer or interaction between our audience who are here. So Guru, the moderator, the chairman of the show, I will hand over. One of the most intellectual, especially not only, so I would call him, I preferably call him economist, but actually he comes from finance. So a combination of finance or financial analyst and economist. Guru Savle, over to you.
Akram, thank you very much, and thanks for the great job you are doing at Policy Times. It's been a great platform. I know I've been on this platform for on several occasions, and each time I come here, I take away a lot of things. At the beginning, the outset, I want to kind of welcome everyone from around the world, India, US, and other countries. And it's very, very exciting to be a part of this conversation with all of you. And of course, we have our expert. I'll be introducing him pretty soon. And at the same time, I want to start this conversation with a caveat, particularly the kind of expectation Akram has said. I'm Guru only by name. I continue to learn. And so I'm still a student of markets. And we have experts. We have all of you in the audience who probably are very, very deep-sighted about investments in capital markets. And We'd like this to be a participative forum where we would encourage interaction. A very quick introduction about me. I am representing Edward Jones, one of the leading financial advisory firms. As Akram said, Edward Jones manages about $1.5 trillion in assets, and we offer advice on investments, on retirement accounts, and so on and so forth. Our goal is to help individuals, businesses manage wealth, and we are a center for end-to-end wealth management. And I'll just pause there. And it's really time to bring in our expert, Chad Dzik, and I both are based in Dallas. We are extremely fortunate to have Chad with us today. For those of you who might need some introduction about BlackRock, BlackRock is the leading asset manager in the world, largest asset manager in the world. They manage about $9 trillion in assets, and about $22 trillion go through their risk management platform. And Chad will talk more about their risk management platform. And BlackRock is the go-to kind of a firm for the Fed in the US. And in 2020, they were engaged to advise on assets and asset buyout. And Chad will have a little more to share on that. So we are indeed extremely lucky to have BlackRock and Chad along with us in this forum, and it only makes it that much more informative. And Chad himself is an icon in the financial services industry. He's got about 20 years of experience, extremely insightful, a great speaker. He's delivered about 2,000 presentations, and he's my go-to person in the investment world. And by virtue of my job responsibilities, I've had a great opportunity to work with Chad and his team, and we do work together day in and day out. And Chad, thank you for a great partnership. Welcome to this forum. I know this is your first international, particularly Indian platform for you to present. You have a different set of audience, and I'm sure you will enjoy this audience as well, like you do with all our other webinars. I welcome you to the show.
Thank you, Guru. And yeah, just thank you for the opportunity. This is my first time to ever speak to an international audience. So yeah, extremely excited, nervous, a little anxiety. And I'm most looking forward to the questions from everybody. So please feel free to ask questions in the question and answer. That's what that session is for. So please don't hold back. I'll do my best to try to help. And if I can't answer the question, I've got some pretty smart folks at BlackRock that will get the answer for us. So just, Guru, thank you for having me.
Absolutely. So the session will last for about 30 minutes, and I will be in conversation with Chad Dzik, and he is the market leader and director at BlackRock. And Chad, I know we are going through a tremendous transformation in this world, particularly from 2020. Healthcare has redefined markets, redefined economies. It's the buzzword, talk of the town, talk of the world, Delta variant, and several other bits, right? So we thought we were almost done with pandemic, but pandemic is back again in another form. So Delta variant, it has made an impact not only on the healthcare part of this world, but also on the financial part of the world in terms of investment strategies, in terms of the way countries are looking at this pandemic impacting economies, individual investors wondering what this variant can do. Should we buy? Should we sell? Should we really be worried about Delta variant, or should I just sell away all my stocks and just keep money in cash so that I'm not taking a risk? And we don't know yet, right? And I'm sure you have a lot of answers to some of these apprehensions. And two parameters on top of all our minds today, even as we deal with Delta variant and its impact on investments, is inflation and interest. Right. So the world is talking about inflation. US unusually is witnessing a huge increase in prices and commodities, and it is quite unusual and uncharacteristic of US economy. And if US is experiencing that kind of inflation, what does it mean for the rest of the world? And I know there's some guidance on Fed, about interest rates, and I'll let you talk about that. Well, I was watching CNBC this morning, and the anchor was saying Delta variant is not derailing the recovery; it's probably delaying the recovery. So, Chad, step in, cover all of that for us, and look forward to your comments on
Yeah, so the Delta variant is, I think you said it perfectly there at the end. It is slowing things down, but we actually talked to scientists from a couple of companies. I won't mention companies' names, but on Monday morning, we did some modeling with some scientists at one of the companies that is producing vaccines, and they believe the Delta variant in the United States will peak in the next 2 to 3 weeks. They are watching closely, though. For example, I took my two young ones who are 9 and 7 to school today for the first day. And so with children being back in school, there is some fear that that could actually help the virus spread quicker. And so the next couple of weeks are going to be very tricky. We expect some volatility in the market over the next month or so. But Guru, we agreed with the scientists that the Delta variant is likely to peak in the United States in the next 2 to 3 weeks. Worst case scenario would be middle of September. And then we think you will see things subside very quickly. And you should actually see a very strong rally into the end of the year, because the infrastructure bill was not near as big as we thought, which is actually probably a good thing. And the Federal Reserve, which will speak in Jackson Hole in a couple of weeks, is likely to be very, very conservative with any type of reduction of the asset purchase program. And the Fed is still currently purchasing $120 billion per month in Treasury and agency and mortgage securities. So extremely accommodative. And we think as the Delta variant subsides, you should see the US market have a very strong rally here at the end of the year. Now, the challenge is there's a lot of bifurcation across the globe. And you're seeing it's almost like a relay race in the Olympics. The US has run the first leg of the relay. And we got off to a really fast start. And we've had a really strong recovery. And now we're going to hand the baton to Europe. And Europe should see a really strong recovery over the next 6 to 9 months. Where there are challenges, and our team has visited about India, Indonesia, Brazil, Mexico, some of the emerging markets are having a much tougher time with the Delta variant because the vaccination rates are much lower in the United States versus places like India. And so we expect that the US market and the European market are likely to outperform over the next 6 to 12 months. But long term, our favorite markets are still the emerging markets. And India is probably BlackRock's favorite market. Akram, at the beginning, I love what you said about which one is the future. We believe India is the future. BlackRock really believes that India will be the future and will benefit dramatically from the virus in China and companies trusting China less and less. And then you're seeing what China's doing with Alibaba and Tencent. That's a challenge for companies that want to invest in China, and India will benefit from that. And so Delta variant, I think that's a media thing, Guru. You got to be really careful. The media has one job, and that the job a lot of times is to keep you glued to the newspaper or the TV. And we believe that it's just another blip on the radar, and the market will continue to move higher. And Guru, I'll pop up. Yeah, one of my favorite charts is this is one of my favorite charts about investing. The market, as you'll see, this is the S&P 500. It goes up the entire time, the last 10 to 15 years, with a few 5 and 10% pullbacks. But this chart is titled "Always a Reason to Sell." There are always going to be headlines that are going to scare you. And if you let those headlines affect you, the S&P 500, the largest index in the world, with the most assets following it, is up 650% on this chart. But look how many scary things have happened that would have made you think, oh my goodness, and the 5 most dangerous words of all time typically get said, this time it is different. And we would say, no, obviously the circumstances of every event are different. And Voltaire has this famous quote. He says, history never repeats itself, but people always do. Every time there's a crisis, what do you think people do with their money? They get scared, and what do? They want to move it out of the market. So this is another chart Guru and I talk about all the time. Look how good investors are at picking when to invest. In January of 2003, at the bottom of the technology bubble, in the United States, there was $2.3 trillion sitting in money markets at investment companies. That doesn't even count banks and CDs. In January of 2009, right at the bottom of the market, almost $4 trillion sitting on the sidelines. And then January of 21, as the market's having this huge recovery, the S&P's up 100% since last March, and $4.3 trillion is sitting in cash. And if you look at what the market did the last 2 times the cash peaked, the 3 years after the tech bubble, the market made 16% per year. The 3 years after the global financial crisis, the market made 19% per year. And we're off to a pretty good start in the recovery off of the COVID crisis. And the sad thing is, many investors are not participating because they're sitting on the sidelines. And so Delta variant, in our opinion, is, yes, it's very serious. It will have a big impact on emerging markets more than it will the developed market. But we expect the markets to continue to do extremely well. And part of that is, Guru, you ask about interest rates. The United States has a serious problem. And this is also going to benefit places like India long term. So I'm going to show you a couple of charts here. And this is the US federal debt. So this is the United States debt. Okay, so this is government debt. Okay, and this is coming directly from the US Department of Treasury. And the debt levels, if I go back 25 years, the debt levels in the US were less than 5 trillion, and now we're getting close to $30 trillion in debt. Now that's the government balance sheet, the government debt. This is the Federal Reserve. So this is the US Federal Reserve. The US Federal Reserve, directly from their website as well, this shows you their asset. Their asset base was $800 billion in 2008. To fight the global financial crisis, they pumped about $1 trillion into the economy. That was QE1, quantitative easing. And then they did QE2 and QE3, and the balance sheet got up to about $4.5 trillion. They started to taper the asset purchase program, and we were sitting at about $3.7 trillion before the COVID crisis. And look at what has happened to the balance sheet. This is what I mentioned a minute ago. They are putting $120 billion per month into the market. They are digitally printing this money and buying treasury bonds, agency bonds, and mortgage-backed securities to provide liquidity to the market. It's like putting oil in the engine on your vehicle. If your vehicle doesn't have any oil, I don't care how much horsepower it has, I don't care how fast it is, it's not going anywhere. And so the Federal Reserve believes, as the consumer got nervous about COVID and stepped away from spending, the government and the Fed felt like they needed to fill the gap. And Guru, what I would finish with, and then we can get into other questions that you have.
Sure.
Last year, if you compare the COVID crisis to the global financial crisis, the global financial crisis was 4 times worse than the COVID crisis from an economic standpoint. But last year in 2020, we received 4 times more stimulus than we did in 2008. And that is why you've seen this massive recovery in the market. And so the last piece of the equation is the consumer. So right now we have emergency fiscal and monetary support. And we no longer have an emergency. The United States economy is going to grow at 7 to 8% this year, and inflation is 4 to 5%. That is a healthy, growing, recovering, restarting economy. Why are we pumping $120 billion a month into the market? Our firm does not understand this. They need to reduce the balance sheet purchase program. And that is going to cause more volatility. And we think they will start this process at their meeting in Jackson Hole in a couple of weeks. And so between the Delta variant and the Fed, the next couple of weeks may be a little challenging, but we think the next 6 to 12 months will be very good for the markets. And so, Guru, I'll stop there and see if other questions, or if you want to dig into some of the more subsets of the market.
Mm-hmm. Yeah. So you made a good point on the kind of cash that's lying on sidelines, and I just wanted to clarify with you, Chad, that cash does not include bank deposits and CDs and so on, right?
Correct.
So
you include,
probably
you include bank deposits, checking accounts, certificates of deposit in the United States only. It's $17 trillion sitting on the sideline, earning a negative return, a negative yield. And that's the challenge we have today. The world is aging. 10,000 people a day in the United States are turning 65. Europe is much older than the United States. Japan sold more adult diapers in 2019 than baby diapers for the first year on record. The world is aging. That also will benefit India long term, much younger demographics, and demographics are the key to markets. And so long term, you're going to see a big change. Europe has negative interest rates. Japan has negative interest rates. The United States got very close last year. Our 10-year treasury got down to 0.52%. And that is a big concern because inflation is likely to average around 3%. And interest rates are going to stay extremely low because when you have a lot of debt, one of the key things you must do is keep interest rates extremely low. And so one of the most meaningful charts when we're building and designing portfolios for investors is this chart right here. Because bonds play a very important role in a portfolio to reduce volatility. Think about the airbag in your vehicle. Think about the suspension system in your vehicle. It smooths the ride and keeps you safe. That's what bonds do for our portfolio. But the last 40 years, interest rates have declined from 15% down to 1%. And notice how bond returns went from 12% to 7% to 6% to 4%. Do you guys see a trend here? Returns on bonds follow interest rates. And so when you have low rates, let's trace the yellow line back to the last time interest rates have been this low. It was the 1940s and 50s. We expect bonds to return about 1 to 2% over the next 10 to 20 years because these charts work together. Do you know why interest rates were so high 25, 30 years ago? Because we had no debt. When you don't have debt, you can have much higher interest rates. But today, even if we had a bout with inflation, we can't raise interest rates. We're trapped because if you raise interest rates, you have to service the debt at those much higher interest rates. This is one of the reasons we like equities so much moving forward. It's not that we like equities, they're expensive. Historically, they're very expensive. But we like equities because it's the acronym TINA, T-I-N-A. There is no alternative. All of these folks need income, and there's nowhere to get income. Half of the world's assets today have a negative yield attached to it, and so people are going to need to own more equities. So we are helping some of the largest pensions in the world who have never owned equities in their history, who are buying equities for the first time ever. Because if they need to make 4%, how are you going to make 4% with 100% of your money in something that's going to make 1 to 2%? And this creates a dilemma. So with all of this money on the sidelines, it needs to move more towards the market. And we think that will happen. And that's kind of the last thing that should really power markets moving forward. So Guru, I know that's a lot. Let's see what other questions you have and what other questions the audience may have for us.
Sure. So you mentioned about equities, and this is a constant dilemma for any investor in any part of the world, right? Should I buy equity? Should I buy a mutual fund? Should I buy ETF or bonds or whatever? I know BlackRock doesn't deal with equities, but as in common stocks, you have ETFs and mutual funds. So what's your advice to average investor in terms of his approach to portfolio building, what do you think is the right balance?
So in our opinion, so BlackRock, we own $6 trillion in equities. So we have 7 trading desks. We trade 20 hours a day. We have 16,000 employees dedicated to trading stocks. And that's all we do. We don't have a bank. We're not an insurance. We don't do any. That's what I love about my firm. So many businesses, they have 15 different arms and channels. And it's like BlackRock does 2 things. We manage risk and we manage money. That's it. We don't make revenue in any other way. And so the problem is, if you trade stocks, you are trading against the best and smartest people in the world who have technology advantages over you. If you saw the technology that BlackRock has, you would probably never buy another stock, because you are at a disadvantage when you're trading against these algorithm-based programs that these firms like BlackRock and Vanguard and Capital Group, some of the best companies in the world, that's who you're up against. And that's very, very tough. So Guru, there's a study that BlackRock did, and that's why we really encourage people to own mutual funds and exchange traded funds. So this is one of my favorite charts, and then I'll give you a little more empirical data that goes back even further, but this is looking at the last 5 years. This is the Russell 3000 index. These are the 3,000 companies in the United States good enough to become public companies. So these are not fly-by-night companies. This is the Russell 3000, and it's up 15.2% per year over the last 5 years. Historically, over the last 100 years, the market makes about 8 to 9%. This is one of the best 5-year periods in history. What is shocking about this, Guru, is when the market had one of its best 5-year returns ever, 34% of stocks in the Russell 3000 lost money. As an investor, what we try to do at BlackRock, and Guru, I think you do an amazing job of this for your clients. We try to help our clients reach their goals and objectives for the money with the smoothest ride possible. My kids love to ride roller coasters. That's for kids. I don't want to ride a roller coaster with my portfolio. I know my parents don't. No, roller coasters are for grandkids. They're not for your retirement portfolio. They're not for your long-term serious investments. And I don't like these odds. And I look over here to the right, there are thousands of mutual funds and exchange traded funds, and only 0.2% of them over the last 5 years have lost money. So when you buy a diversified portfolio of mutual funds and exchange traded funds, and we own iShares, the ETF company, we love exchange traded funds, especially for money that is going to be taxable, because it's a much more tax efficient vehicle. It has a much lower cost, but we like these odds. But Guru, I went back to 1980 because I don't like 5-year studies. I feel like people can manipulate the data. So I thought, I'm going to do some research. I'm going to show BlackRock. I'm going to come up with my own chart. And I went back to 1980. And since 1980, the Russell 3000 index is up 75 times.
Wow.
You would have 75 times more money today if you would have invested in the Russell 3000 in 1980. You've gone through the tech bubble, the global financial crisis, the COVID crisis, very long period of time. Do you know what's amazing? 7% of companies in the Russell 3000 generated 100% of the return in the Russell 3000. 7% of the companies generated all of the return. The problem on the other side is 40% of companies in the Russell 3000 lost at least 70% of their value and never recovered. It's very hard to figure out the companies that are going to win and drive most of the returns in the market. And so we are not a fan of owning a huge portfolio of individual stocks. We like to have a diversified portfolio of mutual funds and exchange traded funds. And then Guru, the last part of it that I'll pull up real quickly, if I can find this chart. The key to investing is there's really 2 things. Number one, before you ever invest your money in the market, you must understand the arithmetic of loss. This was so profound for me when I was a young investor, and I learned this, that if I lost 20% and I made 20%, I was underwater. If I lost 30% and made 30%, it's even worse. And so the point is, losses harm your portfolio more than the equivalent gain will help you. And if you look at some of these instances, like the Great Depression right there in the middle, it was down 89%. It took 18 years to get your money back. Why? Because if you lose 90%, it takes 900% to get your money back. Do you know that Amazon, one of the best companies in the world, has lost 90% of its value twice? How hard is it to hang on to that company? One of the best companies in the world. Apple has lost more than 90% in its history twice. Like most investors, when it's down, what do you think they do? They sell. And so you want a diversified portfolio that you're able to stay in for a long period of time, because that's the other key to investing is time in the market. It is not timing. There is no way to time. We have tried it. We have tried every algorithm you can imagine. And what we found is the best thing is time in the market. So if you invest for 1 month in stocks, you only have a 63% chance of making money. If you invest for 5 years, it's 88%. There has never been a 16-year period where you have lost money. So even if you're retiring and don't want to take as much risk, we think stocks should still be part of the equation, because bonds are going to provide very, very, very low returns for a long time because of the debt issues, not just in the US, but around the world. And we think stocks are the best way to go, but you need to have a longer time horizon. Your best friend is understanding the arithmetic of loss and time in the market. That is the key.
Chad, this was very insightful. Continuing this conversation from an individual investor standpoint, if I was in India today, or if I was outside US in any part of the world, I would be looking at what's happening to US dollar and how will it impact my investment strategies, whether it's in India or Indonesia or Singapore or wherever. So can you kind of share some thoughts on where does BlackRock see dollar going, and how will it impact international investors?
So the last 10 to 15 years, the dollar has been very strong. And we believe, because of that debt chart, the debt charts I showed you earlier, that the dollar is likely to start weakening. Our government doesn't know how to manage a checkbook. They really don't. And the COVID crisis, we definitely needed to increase debt, but the debt has been a problem for a long time. And with an aging demographic, with more people utilizing the entitlement programs of Social Security and Medicare, a lot of the debt is going to be with entitlement programs. And most of the budget of the government moving forward over the next 10, 20, 30 years is going to be on entitlement programs and servicing the debt. And so it's going to put the U.S. at a disadvantage long term if we don't figure out how to better balance the budget. When the U.S. has been the most powerful in history is when we have a balanced budget. And so, Guru, it's just a big problem. The debt is we're addicted to it. We're addicted to debt. This is just a scary chart when you look at it long term. But even if you look at the shorter term over the last 5 years, it's just amazing. 5 years ago, we were under 20 trillion in debt, and now we're close to, we'll cross 30 trillion by the end of the year. And then you look at what the Federal Reserve is doing. How does this end? What's the end game here? Like, how do you go from $800 billion balance sheet to 8.2 trillion? How does this end? Well, one of the ways it ends is the dollar starts to weaken. And then the other problem you have with the United States is if interest rates ever rise, if interest rates rise quickly or dramatically, the United States will be in very big trouble. Because that you could see us default on the debt if you saw interest rates go to 5, 6, 7%, because you can't service the debt at those type of interest rates. And so we believe interest rates will stay low. So the U.S. is likely not to have to worry about that, Guru. But the debt levels increasing, the Fed balance sheet is definitely going to weaken the dollar. The biggest, the biggest benefit the U.S. has had the last 20 or 30 years is we're just the best house in a bad neighborhood, right? Europe is worse. Japan is worse. And no one really trusts China. I mean, who's going to buy a barrel of oil in the Chinese yuan? It's just not going to happen. Folks don't trust China, and the way their government comes in, and takes over, especially taking over some companies, you're not going to see the Chinese yuan be a big part of any type of basket of currencies or ever take over as the global currency. Europe and Japan are worse off than the United States from a debt perspective and a negative interest rate, and they're older and have worse demographics. So that's what buys the US some time. But Guru, you are likely to see the dollar weaken over the next 10 years. And in that, you should see international markets perform better. And you should see emerging markets perform extremely well. So although emerging markets are going to have a difficult time with the Delta variant and COVID over the next year or two, because the vaccination rate is much lower overseas than it is here in the US or even Europe. But I would say use the challenges in the emerging markets, the dips and the pullbacks and the corrections in those markets to be adding risk in emerging markets, to be adding risk in India. Because long term, I think you will see China will continue to grow versus the US, and India is what BlackRock believes is going to be an economic superpower over the next 10 to 20 years. The demographic trends are significantly better in India, and you're going to see a lot of companies continue to do business in India. So that is, kind of our take on debt and the dollar weakening, which should benefit, international, but especially emerging markets.
Chad, that's very helpful. I know we've been in several conversations and in past conferences where we spoke about what is investing. Is it about making a return? Is it about making 10%, 15%, 5%, whatever? Or is it about risk management, right? So most of us as investors, we're really looking at, okay, how much can I grow? Is there anyone in this audience who does not want to make money? Right. The only reason we invest is we want to make money and we want it to grow as quickly as possible. Right. But at the same time, one of the biggest lessons I learned in wealth management and investment banking is investment is not about just watching returns. It's also about managing risk and really looking at are we positioning our portfolios for the future? Is a portfolio benchmarked against Fed and so on and so forth? It'd be very interesting to hear your perspective on that.
Yeah, so I would say that investing should never be about performance. Investing should never be about I need to make 5%, 10%. I want to make 15%. I've seen people say, well, I expect to make 20%. The problem with that is you cannot control markets. You cannot control performance. What we want to try to do is come at it a different way. We want to see what are your goals and objectives, and then how do we design a portfolio that has the least amount of risk possible to get to that goal and objective. And that, Guru, that's what the Aladdin risk management system helps us do, is it gears the portfolio based on what will allow you to sleep well at night and help you reach your goals and objectives while keeping risk low. It's that chart I showed a minute ago. You do not want to lose 30 and 40 and 50 and 60 and 70%. It is just so tough to recover from that. And so for us, it's more just owning a really well diversified portfolio that can achieve those goals and objectives. And what I would say, Guru, this is a chart that we use all the time at BlackRock, and it usually surprises people. So what you're looking at here is the S&P 500 going back to the technology bubble in 2000. And on the right-hand side is a diversified portfolio. And the problem with a diversified portfolio, Guru, the problem with owning a lot of different investments and having a collection of investments that you put together is you're never going to be happy. You will never be really happy. And here, let me show you this. From 2000 to 2002, the S&P 500 was down 40%. A diversified portfolio was only down 17%. But you know what you thought when you lost 17? You didn't say, well, Guru, great job. I appreciate the diversified portfolio. No, you would be mad at Guru. You lost 17% of my money. You're mad. Okay? So you did really well versus the market, but you lost money. Now, from 2003 to 2007, international markets did amazing. So a diversified portfolio almost kept up with the S&P 500. But now you're upset because your coworker made more money than you. You didn't make as much as the market. So you're still not happy, even though you're up 80%. Then the 2008 crisis happens, you're down 37. You only lost 24% in a diversified portfolio, right? I'm not going to send Guru a thank you card and say, Guru, thank you I gave you $1 million and now it's worth, $780,000. Thank you. That was awesome. A great experience. But I appreciate you beat the market though. And then the market goes up, and this is where it was really hard for investors because the US market dominated every market in the world. And so the S&P did 351, the diversified portfolio only did 195. And I'm not going to continue to go through it, but you get the point here. But at the end, notice, going back over 20 years, your return was 268 if you invested in the S&P. It was 275 if you invested in the diversified portfolio. The diversified portfolio actually won. It actually outperformed the S&P, and you did it with a significant, less risk. So the key is not making more on the upside. Most people think you win in investing by picking the best stocks and winning on the upside. No, it's actually having a diversified portfolio that manages the risk on the downside. It's the downside that is so much more important than the upside because of what I said earlier. Losses harm you more than gains will help you. So Guru, that's our take at BlackRock is, just diversified and time. I know there's kind of a theme here. It's diversification over a long period of time. It's boring. It's not fun. It's not exciting. Your friends aren't going to be impressed, but your bank account will. And that's how we think about it.
Sure. No, that is great. I think that's very, very helpful. So I'll actually turn this over to the audience for questions. And before that, I just have one comment to make. You made a very interesting reference to how media is kind of hyping up the Delta variant impact, and to an extent where common investors get scared. But I really wanted to kind of acknowledge the kind of good work Policy Times is doing. It's a different kind of a media platform, which is very strategic, looking at macro level indicators in the economy and trying to correct those traditional media perceptions. I think that's thanks to Akram and his team. So Akram, let me bring you in. Let's hear if there are any questions from the audience or any questions from yourself as well. And I know it's a short time, it's a huge topic, but we will try to do our best. At the same time, I will leave my phone number and email ID with your audience, and they can reach out to me even after the conference if they want to have any one-on-one calls.
Right. Thank you, Guru. Absolutely, you are doing a fantastic work. And I think the kind of the portfolio or experts that we are bringing in our programs. I think it is going to benefit a lot, not only to investors but also the entire investor community. So that my question is actually what Jack Ma asked before he disappeared. I'm sure I will not disappear because I'm in India. Jack Ma said that most of the investors, this is a little out of box, I'm asking out of my curiosity. I should have asked Narendra Modi or Xi Jinping that most of the investors, when they invest or when they make strategy, they are risk averse. They want to control risk. In today's time, if you really want to encourage innovation is all about making mistakes. So if you really want to invest in youth, invest in innovation, then your approach of managing risk has to shift to actually protecting mistakes, because all the great inventions and innovations happen in the society are the mistakes or are by mistakes. What is your view on this?
I couldn't agree more, right? I mean, you have to take risks to make money. It's just diversifying those risks, I think, is the key. And Jack Ma is one of the brightest minds in the world. Like, he's actually come to speak to us at BlackRock. It's just that was one of the highlights of my career. Just fascinating. That was back when the company was going public and he was kind of making his rounds. And but yeah, I feel like the challenge is so many investors, especially overseas. In the United States, our savings rate is only 5 to 10%. Investors spend almost everything they make. In the European markets, it's 50, 60%. Japan is 70%. China is 50%. I don't know the number on India, but BlackRock has these savings rates. And just to give you a visual, this is always just blows my mind to see personal savings rate, this is on the Fed's website, the personal savings rate in the US is about 6 or 7%. It was that before the pandemic. And then it went to 34% when everyone got scared. But what happened right away? Even during the pandemic last year, people started spending. They felt better. Then we had the scare in January with the pickup in cases, kind of like what we're seeing now with the Delta variant. That's why we think there could be a little lull here in the market, some volatility. And then you get this big spike. This is all the stimulus. But look how quickly people spent the stimulus. And so it's just, I would say the challenge that the rest of the world is going to have is so what central bankers around the world are doing, the ECB, the Bank of Japan, the Federal Reserve in the United States, Akram, they basically have the system set up to punish you to save your money. They are trying to punish you to be a saver where you will basically earn nothing. And if you factor in inflation, you actually have a negative return. So their thought is, Akram, is that people will start to take more risk because they're getting no return. And what's been shocking is US investors have kind of gone crazy taking risk, and the rest of the world has not. And so I think with where interest rates are and a bunch of broke governments around the world and central bank policy keeping rates artificially low so they can afford the debt, investors overseas need to take more risk. And when you take more risk, it's very scary. So you need to be diversified. You want to have that basket of securities or basket of stocks or basket of exchange traded funds that fits your risk profile. But I think that's one of the biggest issues in the world today. And our CEO, Larry Fink, says it all the time. We have people under-risked and under-invested. And it's BlackRock's mission. And that's why we're trying to do more business in India. We're trying to do business in China. You're going to see BlackRock products available to Indian investors, to Chinese investors. Larry Fink's deal is he wants to educate. As you see today, we don't talk about products. We want to educate. We want people to understand markets because you have to take risk to make money. And I would say that most of the world doesn't take enough risk. And I think in the United States, people take way too much risk. And so I would just say for overseas investors, you must take more risk, but do it very calculated, do it very smart. And someone like Guru can help you all with risk management. But Akram, I love the question, love it, because that is our CEO's mission. We want to help more people utilize the market to reach their goals and objectives. And I'll share my personal story. My dad works at Anheuser-Busch. He worked there for 43 years in a brewery working on the machines, no college education. All he did was put his money in CDs and his checking account. And he never had much money. In 2001, I started investing. And I started helping my father invest very conservatively, about 50% in stocks and 50% we would keep in bonds and CDs and other investments. Today, my father's retired, has millions of dollars, and never made more than $30,000 or $40,000 per year. He was lower middle class in the United States. And now he has millions. He's the millionaire next door guy. He's never had debt. He doesn't have a house payment, no car payments. And my mom and dad just saved. But I showed them how to invest 20 years ago. And the compounding of their money at a very conservative portfolio looks just like that chart I showed you. My dad has actually outperformed the S&P 500 since 2001 with a very conservative portfolio, because it's not how much you make, it's how much you keep. But you must take risk. And so my dad would have never had much to his name if he would not have learned to take risk. So hopefully that helps.
Thank you, Chair. Thank you. I'll invite Mr. M.S. Shabbir, who was handling even a much bigger portfolio of many investors, like in multi-million. Right now, because he changed his strategy from normal stock to ethical portfolio, so his investment portfolio has just gone down. But I would request him to ask any question if you have. So Sensage is one of the leading financial firms in India, based in Hyderabad. And he is one of the most disciplined portfolio manager I have ever seen. And I think he is giving very good return. And he's also one of the first investors to Policy Times. I have not given any share or equity though. But so he's the first person.
Thank you very much, Akram, for inviting me on your platform. One of the first questions that I have for Mr. Chad is, see, as Sharia investors, you know that we do not get into debt and encourage risk taking or equity participation. So, what should be the allocation since the debt asset is out of our purview? What do you think should be the allocation to gold and real estate and equity if these three asset classes are to be taken? Number one. Two, recently, of late, we have been seeing that in India, there is a lot of push towards investment in the overseas market, whether it be Japan, China, or US. So, why is it that people are looking outside India when actually outsiders are looking in India? Can you answer this question?
Yeah, so that's a great question. So thank you for being on the call. It's an honor to be able to speak with you and just appreciate what you do, and would love to learn more about what you do. We need to get you working at BlackRock, I think, is what it sounds like. So the first thing is gold and real estate. What was the other? I know there were three: gold, real estate, equities. Okay, so we look at gold as something that you should have 2, 3, 4% of your portfolio in gold as a hedge to what's going on with global currencies. We think about gold like salt on a meal. So I like to put a little bit of salt on my meal. So if I'm sitting down to have a meal and I've got this great meal in front of me and I've got this great ingredient called salt, since it's a great ingredient, if I took the top off of the salt shaker and dumped the whole thing on my meal, I would take a great meal and a great ingredient and ruin the great meal because I use the great ingredient in the wrong proportion. So the mistakes we see investors make is they think the world's going to end and they put 50% in gold or 100% in gold. And we would encourage people to have 3 to 5% in gold. That's what we do at BlackRock. Our flagship funds have anywhere from 0, or I would say 1% in gold to 5%. And Larry Fink, our CEO, who is like one of the best risk managers in the world, does not believe you should ever have more than 5% in gold. Real estate, that's tricky because it depends what type of real estate you're investing in. So we like real estate. We think real estate could be 5 to 10% of a portfolio, especially as bond yields are so low. But you have to be careful what type of real estate are you buying. For example, we don't like malls. We think shopping malls where people all gather and go together, Amazon is going to put them out of business. Walmart is going to put them out of business. And so we don't want to invest in real estate like Simon Property Group, which owns a bunch of malls. We want to invest in data centers, right? We want to invest in data centers. We want to invest in memory care and senior care facilities as the world is aging. So as long as that real estate is tied to innovation and technology, or it's tied to aging demographics, that's the real estate we like. We don't like downtown property real estate, for example, New York City, San Francisco. Those markets are going to be challenged because more people are going to work from home than ever before. So we love real estate, but you have to be very careful what you own in real estate. And then equities, we love equities. So it's really how much volatility can you handle? So, we would say, for example, my father, who is retired, who I mentioned, he's almost 70 years old. He's in excellent health. He might live to 90 or 100. So I showed you that 16-year chart. There's never been a 16-year period where equities have lost money. So my dad has 65% in equities because I don't want to put so much of his portfolio in bonds, which are basically guaranteeing him a negative return. So we are using real estate, we use gold, and we use equities at about 65%. And then for the bonds, we actually are using Treasury inflation protected securities because we think inflation is going to be much higher than central banks are thinking. The inflation is not all transitory like so many people are talking about.
Thank you.
And then remind me, I got so fired up about your first question. Remind me of the second question.
Yeah, the second question is that in India, a lot of these asset management companies and advisors have been advising and pushing money to the international markets, especially at this point of time when the international markets have been looking to India from a longer term perspective. Why is it that the Indian advisors and the Indian asset managers are asking for looking outside India? Because US and India are supposed to be, inversely, when in the US 10 years, when there's a history of US doing good, it's India that has not been doing well. It's a work the reverse way. So why is it that at this point of time, the Indian advisors have been asking to look outside India?
So I think one reason could just be diversification. So first of all, like think about a US investor. We try to do anything we can. We beg investors, please put more into emerging markets. Please put more into the developed international markets. But the average US investor who takes a lot of risk has about 15% of their portfolio in foreign investments, right? So I guess the folks could be wanting you to invest outside of India for diversification because these markets move in different ways at different times. So it is good to have some outside investment. In our perfect world at BlackRock, it would be 55 to 60% US, and it would be 40 to 45% of the money would be in international markets. And we would have a big piece of that long term in India and China, because India and China are going to be very different, right? They're going to move at different places. So I think that's the first reason they probably do it, is diversification and stability in markets like the United States to complement Indian investments. But on the other side of it, I agree with you. I think what investors do is they chase returns. So the return has been better in the United States than it has been in India. That's why we're so excited about India, is we think if you look at the demographic trends and the debt situation and the way companies view India today, India is likely to outperform the United States moving forward. It's just going to have more volatility. So I think pairing different markets together can help reduce the volatility and decrease the risk in a portfolio. So I would assume that's why they're doing it. But I still think as an Indian investor, I would want, 50, 60, 70% of my assets to be in Indian investments.
Yeah, I think Guru would like to touch also on this.
Yeah, sure. No, absolutely. I think there's also a significant, a trend in terms of Indian companies and, average Indian investors looking at international investments. And there's also this huge entrepreneurial world in India, the startup ecosystem that are really looking at investing in the US, etc. So I think there's also a shift in terms of corporate strategies, how the capital is flowing into technology, innovation, etc. And with all the large tech companies from India making it big on NASDAQ, etc. I think now it's a great opportunity for smaller investors, a common investor in India, to really get a piece of NASDAQ, piece of NYSE. And I think what is really unknown at this point in time is that there's so many Chinese companies that list on US capital markets, NYSE and NASDAQ, but not as many Indian companies. It's not that they're not capable. I think there's a gap in terms of awareness, and who would believe in India that it's possible to list a pre-revenue company from India if it has the right credentials to get listed on the US stock exchange. I think some of these shifting trends are also triggering individual investors to look at, can I invest in Germany? Can I invest in US? Can I invest in Singapore, and so on and so forth? So that's just my perspective on it.
Thank you, Guru. I'm unmuting everyone now, so everyone can unmute yourself. So I would invite another asset manager who is handling a big debt portfolio. I think debt manager, more to be specific. I don't know exact title, but Ajay Kumar, he's handling a good portfolio in India. Ajay, what would be your question? Let us keep it a very short question answer. So that
I would like to ask only one question with Chad. So if your focus is to invest in equity, do you foresee that the unlisted companies or the emerging private limited companies, there the scope of getting return is much better or much higher as compared to the listed companies?
Yes. So what I'm going to pull up on the screen here for you, AJ, is our capital market assumptions. And this actually is on our website, so you guys can kind of view this. But what you'll see is U.S. private equity up here at the top. U.S. private equity is expected to have about a 19.5% return over the next 5 years. If you compare that to US equities, that is 6%. So we expect US equities based on our 3,000 factor model to do about 6% and private equity to do 19.5%. Now, the difference is on the bottom of the screen it's not on this chart, is the volatility. The challenge with private markets is the volatility and the illiquidity premium, right? These things aren't liquid. And so it's amazing how many investors think it's like a Ponzi scheme when they try to get their money. And they're like, no, remember, we told you about this. You can't have access to your capital. So it's a challenging market, AJ, but we think the biggest returns will come in the private markets. So many companies today are not becoming public companies. They do not become, if they're, like our thought today is if a company becomes public, 90% of the time it's because they're broke and they need capital. They're not coming public for any other reason. They need capital. And so a lot of times, BlackRock, we are huge investors in private equity. And we now have hedge funds and all different type of ways to invest in it. But you have to, they have big minimum investments, and then you don't have liquidity to your capital. So you're getting paid a premium for giving up liquidity. But yeah, you hit the nail on the head. Private markets that's right on our website. 19.5% return projection versus 6% on the S&P. So more than 3 times the return. Now, we think the risk will be 3 to 5 times higher than the market. So the average investor who can't even hang on to the S&P 500, I saw someone in the chat posted it, investor returns versus investment returns. Like it's amazing what the return of an ETF or a mutual fund is versus what the investor's actual return in the product is. So private investments, they're the glamorous thing to want to buy, but you have to have a strong stomach and you have to really know what you're doing. But yes, private equity, that is where the money's going to be made. And private debt too, same thing. Private debt, direct lending. So BlackRock is doing direct lending and private credit, and we're getting yields of 6 and 7%, whereas the 10-year treasury is 1.5%. You have to be able to give up your liquidity though, which is a really big thing. So great question. And check that out, BlackRock Capital Market Assumptions. You can look at it on our website, but private equity is by far our number one asset class for the future.
Thank you.
Thanks, Jed.
Ravi, thank you, Ajay. Ravi Natarajan, a brief intro and then please, any question?
Yeah. Hi.
Can we interrupt for a second? Akram, can we do time check? Yeah, can we just do a time check? Chad, how much time would you have to wrap up? 5 minutes?
I've got 5 minutes, yes.
5 minutes.
Okay.
So we probably have time for one more question and we'll wrap up.
Okay. Thank you very much. My name is Ravi, and I run a company by the name of FinIntent Investment Advisor. This is the first time that I'm attending this kind of a session. Thanks to Shabir sir to have sent across the invite to us, and very privileged to hear you, Chad, and to know the outlook. If you can give us some insights on the debt outlook as far as India is concerned. You did give a broad debt outlook on the US markets and the Japan markets, etc. How does Indian debt market look like, and what do you foresee it over the next 2 to 3 years' time?
Yeah, so Guru, if you don't mind, make a note of this, and I will check with one of the analysts at BlackRock. We have a team that covers India. That is not my expertise, so I don't know the debt markets in India very well, but I can definitely get Guru to provide some commentary for you. As far as the debt markets go in Japan or Europe, it's a disaster. Interest rates are negative. The only way you're making returns is currency swaps, and that's just that's not why you buy bonds. That adds a lot of risk to owning fixed income because of the having to do currency swaps to try to make anything on the investment. So we're not a big fan of debt in Japan or Europe. The United States, I mentioned in a minute, the 10-year treasury yield is 1.2. Right now, inflation's 5%. Inflation is going to come down to 3%, but the yield is going to be less than the inflation. So you're guaranteeing yourself a negative return. And that's the problem in the debt market today is half of the world's debt that BlackRock has access to purchase for our investors has a negative yield attached to it before inflation's even factored in. When you factor in inflation, 80% of the world's debt is going to have a negative return. And so that's why we're doing more private credit and we're doing treasury inflation protected securities, because we just think inflation is going to be higher than what people expect. And there's just no return to be had in debt markets. We think equity markets are fairly expensive. We only think the S&P does 6% over the next 5 years. Why will it do 6% with the valuations where they are? It's the TINA acronym I said earlier. There is no alternative, so people are going to buy more equities. And that's why I said to Akram earlier, I think the key for international investors is to take more risk. The debt markets there's just very little money to be made, and you are taking a significant amount of risk to do that. So bonds are no longer the safe asset. You're actually taking risk to purchase them.
So Guru, I'm sorry, I'll take just one, if some time is allowed. So just one last question, Mr. D.V. Suresh. Mr. D.V. Suresh, a quick intro, and if you want to ask this question by yourself. A very interesting question you put, actually. Yeah, please go on.
Yeah.
A brief intro before that.
Well, I'm a CFP by profession, and I'm also on the advisory board of Financial Planning Standards Board, that is FPSB in India. Well, I think I've got the answers almost. Though I put the question there, I got the answer from Guru when he explained that. Yeah, I got it. And really, the session was very interesting and very insightful. Thanks for a lovely session.
Thank you for being on the call. It's an honor to speak to everybody. And Akram, just thank you. This was amazing. Like, what a great deal you've put together, and just so great questions. And just, I feel honored. Like, it's a blessing to have an opportunity to speak with everybody today.
Like, we can have the final closing message from Chad, and then Guru, and then we'll close.
Okay.
Chad, the closing statement or final message.
Yeah, I would just thank you. Just thank you all for the opportunity. Closing remarks I would say diversification. Buy quality investments. Don't ever buy something you don't understand. If you can't explain it to a 10-year-old, don't buy it. It's just buy quality investments, and then time horizon. And then if you want to read the best book about investing of all time, there's a book called The Psychology of Money. It was written by a guy named Morgan Housel. It is my favorite book I've ever read. I read a book every month for 20 years. My favorite book in 20 years, Morgan Housel, Psychology of Money. He tells fascinating stories about people that have made huge mistakes with money. And it's amazing, from the CEO of Goldman Sachs, who got arrested for insider trading, to Jesse Livermore, one of the most famous traders of all time, who made $3 billion, equivalent in today's dollar, $3 billion on the worst day during the Great Depression, and then lost it all 3 years later and committed suicide. He tells stories about money so you understand the psychology of money. We teach investing as finance, as math, and it's really more behavior and psychology than it is finance and math. So Akram, just thank you again. This was just an awesome opportunity, an awesome venue, and I'm just grateful for all of you for the opportunity.
Thank you, Chad. Would love to have you in many future programs like this and interact with Indian investors and stakeholders. Guru, your final message.
Sure. Thanks, Akram. Chad, thank you very much for being here. As always, I know we have a long way to go, and we'll do many more of this. My closing comments, I would go back to the key message. Investing is not all about returns. I think risk management is really critical, which is why I have hundreds of clients. And what we really do is, even if you're not clients, if you need to get your portfolio evaluated for risk that it is bearing, and if it's really positioned for the future, BlackRock is a great team. I work with them all the time. We can run your portfolios through the Aladdin risk management platform and really tell you how your portfolio is positioned. Is it positioned for future? And then that might be a much more balanced approach to investment. If there's anything I can do for any of my friends, family back in India, anywhere in the world, I'm happy to do that. And Akram, thank you for providing this platform, because through your platform, I also I have a pleasant surprise today. I met Suresh. Is actually my brother. I didn't know he was coming to the seminar. Hi, Suresh. I didn't even know that.
It was a pleasant surprise for me too. And I should thank Shabir for that. He sent me the link.
So it's been a long time since we spoke, and good to see him here. I know my sister is also online here from Bangalore, and it's quite a interesting moment for me. So thanks to Policy Times for bringing us together.
Yeah.
Although briefly, yeah. And I just have one small announcement. Akram has given me a great honor to host a show on this platform every fortnight. And our next program is on September 2nd. And we'll be focusing on ESG investing. And the theme is World in 2030. And this will be, we invited speakers from Capital Group, American Funds, John and Maddie are going to speak with us on 2nd September. Akram will communicate the time, etc. And we look forward to having Chad back again in September. Chad, I'll coordinate with you. But thanks for your time. Audience, thank you so much. It's been wonderful interacting with all of you. Any questions you have, Akram, please share my phone number and email on the chat, and you're free to reach out to me.
I will just share your details in the chat box. Thank you so much, Chad, and thank you so much, Guru, for chairing such a beautiful session, and for Chad for giving absolutely fantastic overview about the US market. All our participants who joined here, who themselves are actually institutions leading many big portfolios in India and different part of the world. I think let us build a synergy. Let us, whether it is Indians investing in US or US Americans investing in India, let us this be a gateway of mutual investment. So Shabir sir asked a question. My answer to that is that despite America producing so much of thing, or India producing thing, India exports to America, America exports to India, China exports to the world, Europe exports to everyone. So we all export. So this phenomena is never going to stop. So with this, Policy Times will be always committed to organize programs like this. And thank you. We meet on September 2nd. In between, there will be many such shows on education, healthcare, technology, startups. But stay tuned and let us be in touch. Thank you. Good night, everyone.
Thank you all. Bye.